Good morning, traders. It's Wednesday, the 12th of October, 2016. It's 8:03 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The news flow overnight involves the readiness of the market for the FOMC minutes today. The British pound is staging a surge a little bit. Um, And so the market was paying attention to that overnight. There's not much else to report. That could be influencing us today. Earnings came in yesterday for Alcoa, and apparently that's part of the reason why the market started to drop. But anyway, you can follow the news yourself. The big conversation right now is still the OPEC meeting, um, and the conversation around that. So that's what's driving us mainly. As far as what we did yesterday, actually, as far as expectations for today, what's on deck for this morning is we had Fed Speaker Dudley already at 8 Eastern. We have Fed Speaker George. Fed Speaker George is expected to speak at 9:40. That's 10 minutes after the open. Following that, we have the US FOMC minutes from September 20th to the 21st. That's at 2 p.m. Eastern. And then we have ECB Speaker Mersch right at the US cash close at 4 o'clock Eastern. I see a 3-year note auction and a 10-year note auction, but nothing else on deck there. So yesterday, the main expectation was for the continuation of the auction that we've been in. A As I've drawn before, we've had a wedge forming. Didn't draw that right. We've had a wedge forming, and the expectation is it was likely going to break one way or the other. The higher probability supported a break higher, which did not happen. Of course, as we saw yesterday. Yesterday we opened with a gap down. We were trading at about 51.52 with the prior close at about 59. So a pretty decent gap to the close and a gap zone of about 6 points. The expectation is for an open auction on the open and then for the market to become responsive back to the most recent auction up since we are still in a larger balance zone. That was the primary hypothesis. The secondary hypothesis is again to be more responsive, more likely. We are opening again at the point of control, the microcomposite point of control, and we're looking for rotation into Friday's range, and for the market to just basically rest there as it's been doing for the last few days, just a quick move and consolidation. What we actually got was completely different. In fact, I had it down as a pretty deep hypo. It was like hypo 4 or something. What we got is a quick open test higher and a drop before the market recoiled. So I called that the opening swing high and low at 53.75 to 51. Then the market proceeded to, the ES proceeded to drop just after that to the first target, which was the point of control, the Friday point of control at 49 and a quarter. A small bounce to um, just below the opening swing. So a push up to 50.50, and then another drop, and then from there it's just been consolidation, drop, consolidation, drop, consolidation, drop, consolidation, drop, all the way down to to the MC point of control from way back uh, down here at in the 23 area. It's not marked on my flex levels here, but yesterday was a trend selling day. Pretty good, pretty decent range and pretty decent volume. Let's look at the big picture chart here. So you could see on this chart how we've been zippering along here on a daily basis inside of this box, just one day up, one day down, one day up, one day down, and we finally broke to the downside. The wedge in here looked something like this, and the wedge broke to the downside. The expectation is for the market to pull back towards that wedge and then potentially continue lower. The fact that the wedge broke lower changes the overall outlook on a higher time frame. The overall outlook was that we tested below and we rallied back up. We rallied all the way back to the point of control up here at 72.75, and the expectation is that we would likely regain that 72.75, trade around it, and then start moving towards the low volume node at 2180. That would be the natural process for the auction. And day before yesterday, Monday, looked like it was on its way to do that. So that whole idea of the market likely taking back 72.75 is not on deck, is not on the front burner anymore. We have to see how the market treats this last retest area. If it moves, if it continues to move lower into this retest area, then it's likely to recheck the low volume node left behind in the 2100, 2105 till 2115 area, and then potentially get down below the century figure. So I want to state something here and make it very clear. My goal is not to have a bias. My goal is not to have some long-term, here, here's the clairvoyant, oracle view of the market and where it's going to go. I have no interest in that whatsoever. That just gets people in trouble. My goal is to understand what the auction's purpose is. The auction has a personality and has characteristics that are quite repetitive. And that's really the edge. That's the key edge. My edge is not some statistical, back-tested trigger. My edge is understanding what the market is responding to and understanding the auction very deeply. And that's what I encourage you to do. And that's what I'm covering in this Trader Bite every day. Simply look for key areas above and below to test. The market accepts prices and puts volume in there, and it rejects prices and has no volume there. It's very simple. It's common sense. Go to your local grocery store and look at the products that are on sale. Why are they on sale? What kind of volume is that sale bringing in? Is it a short-term sale, or is that sale price something you've seen for years and years and years? Meaning there is no volume coming in at that price, so they continue to advertise at that price. So this is what the market does with every product, whether it's crude oil, NQ, Russell, bonds, notes, Euro stocks, DAX, you name it, copper, it doesn't matter. It's the same idea. The market goes to where there's a lot of volume in general. Volume shows value. It shows acceptance by both buyers and sellers, because we won't have volume unless buyers and sellers are participating both equally. Some are more aggressive than others, but the volume is equal. And the purpose of the market is to execute as much trade at a given price as possible. We're looking for the fair price, folks. Every day we're looking for the fair price given the information in the moment. And that's really the purpose. And so when the market moves away from a key area like we did yesterday, we have to look at a higher time frame to look at what could potentially be the objective for the market. But generally, when the market drops like this, it has not continued to drop with a continuation trade, at least not in a long time. It doesn't continue to drop in that direction. What it has done is it drops and it rechecks that auction, because the drop day is generally a trend day down, which a trend day by definition cannot find value, so it continues to advertise in the direction of the trend until it can find the opposing force, and the opposing force doesn't step in until it sees value, what those participants see value in stepping in and going the other way, or liquidating, or closing their position, or adding to a new position in the opposite direction, or whatever their purpose is. It doesn't matter what their purpose is. But you look at days like September 9th, drop, next day, buyers. Then we have a sell-off a couple days after that, the day after that, buyers. And you see this consistently with this product. Here's a big long range day, a red bar down to the left here. The next day, buyers. I'm not saying today will be buyers. I'm just saying the market does not move in a large range like it did yesterday. Yesterday we had 32 points of range. It generally doesn't come in and put in another 32 or 20 points of range even the next day in that same direction, unless it is moving on news, unless there's something really terrible going on, and the market is having to price that in, and it did not accomplish that in one session, which happens sometimes. And so that's basically why we're looking below and above. We want to make sure that we're not trading into, we're not selling into an area of confluence on a bigger time frame, and that's the goal. Okay, just to be clear about the purpose of all of this. So what we have is a break from balance to the downside, and so that changes things. And now we have to start looking back at, let's get rid of this. We have to start looking back at what it did the last time it was here in balance. What kind of areas did it test? And what it did yesterday is it hit the MC LVN and bounced off. I didn't have that as a level. I didn't respond there. But that's what it did, and it pushed back above the last point of control while we were here. That last point of control was at 3250. 3250 is the point of control, and the market bounced back up. So today, whatever it does today, it's is going to be very important for how we proceed moving forward. So today I'm probably going to sit on the sidelines on the open and see which side is able to affect the most movement. Crude oil is dropping. Oil is down about 1%, 55 cents, trading at $50.26. I'm seeing almost all assets across different classes moving money to safety. The only products that are higher are gold, the US dollar, and the British pound this morning. Everything else is lower. So to me, that seems to be saying that the market's on the sidelines and wants to see what kind of a reaction this move down gets. So as we expand this profile forward, we see it started to fill in a little bit lower. There wasn't all that much volume at any given price to cause any shift. We've left the point of control higher where it was before, 52.75. And the question is, does it move down here to the middle of the range like where it was before, or does it remain up there and then the market then becomes attracted to it and starts moving back up there once it's done exploring to the downside, once it finds its buyers? The fact that it bounced up yesterday, so this little bounce here, does not make it, does not mean that it's done. This is just liquidation on the close. This is normal. This is normal for the market to do. We did move back to the point of control from yesterday. We had very little volume inside of the initial balance. The market's accepting these prices lower. The key play yesterday for me was the pullback to the IB low, and low volume node on a bounce from 31.75 for a continuation down to the naked close right here. And then I didn't hang on to the trade much longer, but that's what we've got right now. And then it's trading, currently it's trading in the lower distribution still. It has not regained very much. The market pushed higher towards 21.40.75 overnight, but was unable to hold on to those prices. And so this is all information that's telling us that it's likely to balance in on the lower end of the range and potentially extend the low from yesterday down. So here's the reopen, pushes right back up to 40.75, which was yesterday's mid, and then it starts to shift down. It looks like it's likely to get a continuation trade and push this 21.27 and a quarter lower, and that's my expectation this morning. I'm not looking for the market to have a bounce just yet. This morning, the key trades for the day, the expectation is for the market to open in an auction. Again, it's against this high volume node, open in an open auction, and then attempt to push higher and then push towards the low, bounce, and then retest this low. We have an impulsive move down. I'm looking for a test of this low at least, and that will be the key primary target um, for this morning. Yesterday's low at 21.2175. If it gets below 21.15, then it's likely to have a run all the way down to 21.05. So look for that. If you're short into that, I would look for a way to hang on. That's not a trade suggestion. That's just my opinion. The secondary hypothesis is an open auction, move towards the opening, the overnight low, make an attempt at that low, find buyers, and then start pushing towards yesterday's IB, but not get very far. The today's range is expected to be smaller. Do not get caught in this trap of believing that since yesterday was a wide-ranging day, today, I missed a big move yesterday, so today I'm going to hammer on it because we're going to have a big move today. Just respond to what the market says, and don't let what you wish or you could have done or what you'd like to have color your perception. Just stick with your plan. Take your scale outs or take your targets as they are. If the market continues to run, it continues to run. Your job is to look for the next opportunity, as opposed to changing or skewing your risk reward just to try to catch a big runner and celebrate it. A quick moment here for the notes. The notes have been doing something really interesting here. If you look at the notes since Brexit, so Brexit was right here. This is a mess of a drawing, but let's see if we can clean that up. Hang on, let's clean this up. So Brexit goes all the way back. Oh, it's not in here yet. Brexit goes all the way back into here. This is the gap up. The market pushed new highs on the treasuries, and they've been on this downward track and continue to be on the downward track as yields are expected to go higher. The treasuries did not breach anything significant yet. The key level to watch out for is right down here. This CLVN is basically going to divide up. The market has already moved from this high volume node into the next high volume node, which is what we're in. And then this CLVN is essentially the cutoff point for buyers to defend. Once it gets below here, it's likely to attempt back to the CLVN, but look for 127 as the next handle to test. The treasuries have been pretty methodical, just rotating up, testing, failing, rotating down, continuing down, balancing, rotating up, testing, failing, and so on and so forth. But overall, they've moved away just like the ES. Now, you expect the ES to drop, you expect the treasuries, the funds to move into treasuries and for the treasuries to go in the opposite direction in general. But since the anticipation is that interest rates are going higher, are likely to go higher, treasuries have been dropping as well. So there's been a fair amount of opportunity here in the treasuries with some pretty good ranges. Yesterday ended up seeing a small bounce with the ES dropping, but overall the treasuries have been holding a very long-term channel at least on the microcomposite level, and have been falling. Again, anticipating lower rates. That's a lot to cover today, very long. Just want to remind you again that tomorrow is the order flow analysis convergence event. We'll be looking at using order flow to hone in on trades, to stock trades, and we'll be talking about that. That's at 4:30 Eastern. Look into the description of today's video that you're watching right now for a link to register. If you cannot attend, not a big deal, but do register so that you can be sent the recording, can be alerted to when the recording is posted, which is usually done on the same day. I'll catch you tomorrow morning. Hopefully today you can um, keep your hands out of trouble and come back to fight another day tomorrow. Good luck. Take care.